Hello everyone and welcome back to lesson 2, basically looking at Bollinger Bands, Fibonacci ratios, as well as daily pivot points for low risk intraday entries that really can allow you to take as much profit as possible in a macro move. So basically what we did last lesson was we looked at the 78.6 Fibonacci extension along with the Bollinger Bands, and then I overlaid pivot points to show you how I got this relatively low risk intraday entry that allowed me to get my stop loss outside of the Bollinger Bands, which is, I mean, that's huge because you can really let price do whatever you want after that point. So let's take a look. The next day it actually did move down. You have a bounce off of the 20-day simple moving average here. That's very typical. But you can see even on that bounce, my stop loss is still very, very far away from price. So even though there's bounce, I got a 6-month put option. I'm totally comfortable. I will let price do what it needs to do. If it hits that stop loss, that's fine. I'm out with no harm, no foul. But I want to let the market and I want to let price do what I believe it's going to do over time, because that's how you make money. You want to be able to sit on positions and let your profits run. All right, so let's take a look at this. So we got that quick bounce, which I was expecting after a huge run up like this. You're going to expect a buying bounce on that simple moving average, especially for people that may have missed this very quick move to the upside. They want to get in. So I was expecting that bounce. My stop loss is way far out from it. I'm letting price do what it wants. But what the other thing is, I was able to at that point. You can take the high point from the day where it extended beyond the Bollinger Bands. And I actually created, nope, that didn't click. Let's see here. Get it up on the top there. And again, I'm using the clipping function to the open, high, low, and close in Thinkorswim. And when I got that secondary high right here, now I can draw a trend line downward. And let's see if it'll do it. Okay. So this point right now is allows me to show where resistance is being found in the marketplace, where price could go no further. So now I'm actually able to gradually move that stop loss below this secondary, or I'm sorry, right above this secondary high, and just again let price do what it wants to do. Now I believe in this particular trade, when it touched this section right here, I believe I did sell half of my position. Just to be able, it's a little overextended to the downside. It was quick. I know it was going to touch the Bollinger Bands. Just to do to this run up, this previous run up, as these days fall off, the Bollinger Bands will again begin to contract. So I know this isn't going to be an expansion event for the Bollinger Bands. So I did take off half the position here, just anticipating a bounce, a secondary bounce. But after that, basically, I looked, and again, you can see that little resistance trend line, price came up, knocked its head off again, and again it goes down. So after this third actual reaction high, I was able to move my stop loss a little bit, just a little bit above that reaction point. Again, it came down and touched the Bollinger Bands and made the fourth reaction high, so I was able to get an even tighter stop loss in that scenario. And what I'm going to show you here is actually, and on this day where it broke and actually closed outside of the Bollinger Bands, I did relieve myself from the rest of that position. But what I did also and I'll actually delete this to make it easier. What I also did was, that guidance trend line where I was able to move my stop loss, I can take the Fibonacci retracements, which is incredibly powerful, especially in such defined moves. I mean, these are beautifully architectured, measured moves. So Fibonacci's just work hands over fist. So what I did was I took the Fibonacci retracement. I had my low right here, which is actually where I got my extension from earlier, and I connected it to the high of that price where I entered that short position. And you can see price actually was bouncing, in and out the 38.2, the 50%. There was a lot of congestion in this area because there's so much support and resistance, and the bulls and the bears are just battling each other. And on such a run up like this, after we're talking about the fifth, definitely fifth wave of Elliott wave theory. there's gonna be a retracement, and I was expecting it to usually hit the 61.8 or the 78.6 when you get such a run up like this. So I was anticipating that, but on this day I relieved myself of that position, and I was actually preparing to go long, be it at the 61.8 or even better the 78.6. So now what I'll do is I should zoom in here a little bit. I have my fibs, I got my Bollinger Bands up there, and I'm going to have to keep my pivot points. Okay, so we can look. Here are my pivot points for my intraday moves. I always have them overlaid. They're incredibly, if, as long as you get that, the middle, the actual pivot point, which is the typical price, the open, high, low, and the close, the average of those, that's the pivot point. It provides you with two supports lower and two resistances higher that are very much respected in terms of intraday traders and things like that. So what I'll do is I'll just click on the pivot points, and what I'm going to do is back them up. So it might get a little bit hard to see, but don't worry, because I'm going to overlay them on every single candle. So I'm going to edit pivot points, show only today. No, I want to see it all over the place. Okay, so I'm out of my position when it hit the 61.8. I mean, I'm actually preparing myself to go long, but there's no candlesticks saying, you know, the buyers are really going to be there just yet. Luckily, I'm out of the position. One day goes by, and we get a gap down. We get a gap down, and it touches the 78.6. Not only does it touch the 78.6, which I'm gearing up to go long, but you're also way outside of the Bollinger Bands. Way outside of the Bollinger Bands. Not only that, so we have it overextended beyond the 78.6. We're outside of the Bollinger Bands, and as you can see, the second support level of the pivot points, which price usually does not escape the second support or the second resistance. It's very, very uncommon for price to escape that. When it went beyond the 78.6, and I have three of those things telling me that this is emotional selling, this is way, way, way beyond, I'm totally comfortable getting in a long position, especially when it left the 78.6. So I went long at this point, and what I did was I actually waited for it to bottom, and I didn't really break my own rules, but I kind of legged in. I got a little bit before the bottom, and a little bit when it was coming out of that, and it was, again, long 6-month call options. And basically, I was able to get my stop loss once again outside of the Bollinger Bands. And when this day actually closed, like, I was already up. I was definitely already up, and you can see that it actually closed above that second support or pivot point support level. It actually closed above that, so everything was looking good, and I have my stop loss. I got my long tail to the downside, and I put my stop loss right, like maybe 20 cents outside of the low shadow for that day. And from then on, we had 3 gap up days. They were each like 100 plus point up days. I mean, that shows that, the buyers are, the circulation has happened. The buyers are back in, and they have strong stop losses, and they're willing to add to their positions very, very quickly. So that was the secondary scenario where I used kind of what I'm calling the gang theory. It's 3 very heavily followed intraday and macro technical indicators that allow me to get into a position with very low risk and get my stop loss way, way out of the realm of typical intraday price movements. So that's the end of lesson 2, and I hope you enjoyed it.